Hey everyone, welcome to this video with worked examples of depreciation. We're diving into the fascinating world of financial mathematics, specifically something called depreciation. In the simplest terms, depreciation is the decrease in the value of an asset over time. Think of it like your car. Every year, every mile you drive, that car loses a little bit of its value. Depreciation helps us account for this wear and tear in our financial records. Why does this matter? Well, for starters, it impacts your taxes. Depreciation is a deductible expense for businesses, meaning it can lower your tax bill. Over the next few sections, we'll break down the three main methods of calculating depreciation, each called flat rate, unit cost, and reducing balance. First up, we have the flat rate depreciation method, also known as the straight line method. It's like drawing a straight line from the asset's initial value to its salvage value, which is what you expect to get when you sell it at the end of its useful life. Here's how it works. You subtract the salvage value from the asset's cost, then divide that number by the asset's useful life in years. That gives you the annual depreciation expense, which stays the same each year. Let's say you buy a delivery truck for your business. The truck costs $50,000. And you expect to use it for 5 years before selling it for $10,000. Using the flat rate method, you'd calculate the annual depreciation as $50,000 minus $10,000 divided by 5, which equals $8,000. This method is simple and straightforward, making it a popular choice for many businesses. Let's take a closer look at how flat rate depreciation plays out in the real world. Imagine you own a small bakery and you've just purchased a brand new industrial oven for $10,000. You expect this oven to last you about 10 years, and after that, you figure you can sell it for scrap metal for about $1,000. Using the flat rate method, we can easily calculate the annual depreciation. The difference between the initial cost and the scrap value is $9,000, or $10,000 minus $1,000. We divide that by the oven's useful life of 10 years, giving us an annual depreciation expense of $900. This not only gives you a more accurate picture of your bakery's assets, but also reduces your taxable income by $900 each year. Now, let's move on to the unit cost depreciation method. This method is particularly useful for assets that depreciate based on how much they're used, like machinery or vehicles. Instead of time, we're focusing on usage. Here's the formula. You subtract the salvage value from the asset's cost, just like in the flat rate method. But then you divide that number by the total units of production or usage you expect to get from the asset over its lifetime. This gives you the depreciation expense per unit. For example, let's say you buy a printing press for $200,000, and you estimate it can print 1 million pages before it needs to be replaced. You expect to sell the press for $20,000 after it's done printing. The depreciation expense per page would be $200,000 minus $20,000 divided by 1 million, which equals 18 cents per page. Unit cost depreciation, a practical example. Imagine you're running a taxi company and you've just added a new car to your fleet. You bought the car for $30,000 and estimate it can handle 200,000 miles. You figure you can resell it for parts for about $3,000. Subtracting the salvage value from the initial cost gives $27,000. Dividing by the total miles, we get 13.5 cents per mile. For 40,000 miles in a year, the depreciation expense is $5,400. Reducing balance depreciation. Accounting for decline. The reducing balance method reflects a more realistic depreciation pattern for many assets. Assets depreciate faster in their early years, like a new car losing value rapidly. This method uses a fixed depreciation rate applied to the asset's carrying amount. The depreciation expense decreases each year as the carrying amount goes down. For example, a piece of machinery bought for $100,000 with a 20% depreciation rate. In the first year, the depreciation expense is $20,000. In the second year, the carrying amount is $80,000 and the depreciation expense is $16,000. A real-world scenario. Let's imagine you're a photographer and you've just invested in a top-of-the-line camera for $5,000. You decide to use the reducing balance method to depreciate the camera, assuming a depreciation rate of 30%. In the first year, the depreciation expense would be $1,500, which is 30% of $5,000. This leaves you with a carrying amount of $3,500, after subtracting $1,500 from $5,000. The next year, you apply the same 30% depreciation rate to the new carrying amount, resulting in a depreciation expense of $1,050, which is 30% of $3,500. The carrying amount is now $2,450, after subtracting $1,050 from $3,500. Choosing the right method, matching depreciation to assets. Now that we've covered the three main depreciation methods, you might be wondering which one is the right one. The truth is, there's no one-size-fits-all answer. The best method depends on the specific asset and how it loses value over time. The flat rate method is a good choice for assets that depreciate evenly over their useful life, like furniture or buildings. The unit cost method is ideal for assets that depreciate based on usage, like machinery or vehicles. And the reducing balance method is suitable for assets that lose value more rapidly in their early years, like computers or electronics. Depreciation and financial decisions. Understanding depreciation isn't just about crunching numbers, it's about making informed financial decisions. When you have a clear picture of your assets' declining value, you can make better decisions about when to replace or upgrade assets, plan for future capital expenditures, and accurately assess the profitability of your business. Depreciation impacts your financial statements, which in turn can affect your ability to secure loans, attract investors, or even sell your business. Mastering depreciation for financial success. So there you have it, the ins and outs of depreciation. Remember, this isn't just about accounting rules, it's about understanding how your assets lose value and how that impacts your financial well-being. Whether you're a small business owner, a freelancer, or just someone
Till next time, keep wondering, keep learning.
Want to rise to your full potential in your studies and revise like a boss? You can trust Study Guide today to have you covered. Subscribe to this channel and see our website linked in the description of this video to see revision articles to maximize your study gains.